Welcome to a new chapter in our ongoing exploration of wise investing, where the fight against inflation takes center stage. As we step into 2025, the financial landscape remains fraught with uncertainty. Inflation continues to be a pressing concern, steadily eroding purchasing power and presenting both challenges and opportunities for investors everywhere. If you're searching for clear guidance, actionable strategies, and the latest data to safeguard and grow your wealth, you're in the right place. The past year has reminded us that inflation is not just a buzzword or a distant economic threat. According to recent figures, as of October 6, 2025, the Consumer Price Index stands at 2.9% for headline inflation, with core inflation, a measure that strips out volatile food and energy prices, hovering at 3.2%. These numbers are more than just statistics. They impact what you pay at the grocery store, the value of your savings, and the long-term trajectory of your investments. Yet, as daunting as these numbers may seem, they also provide a roadmap. By examining how different asset classes respond to inflationary forces, we can make informed decisions to not just weather the storm, but potentially benefit from it. Let's embark on this journey together, starting with the investment channels that have historically proven resilient in inflationary times. Let's begin with a timeless safe haven, gold. Gold isn't just a glittering metal or an ancient artifact. It has been a cornerstone of wealth preservation for centuries. In times of economic turbulence and currency devaluation, gold's allure shines especially bright. In 2025, gold has once again proven its worth. Analysts project that its price may exceed $4,000 per ounce, a figure that reflects a roughly 30% surge since the start of the year. This dramatic appreciation is not just a relic of past inflationary cycles, it's a current reality, underscoring gold's role as a strategic hedge. But what's behind this surge? Investors worldwide are seeking refuge from volatile currencies and geopolitical uncertainties, pushing demand, and consequently prices, higher. Exchange-traded funds like the SPDR Gold Shares ETF, GLD, currently trading at $357.64, make it easier than ever to gain exposure to gold without the need for physical storage. GLD's robust performance in 2025 mirrors the broader upward trend for gold, making it a practical and accessible investment for those looking to shield their portfolios from inflation's bite. However, as with any investment, it's crucial to approach gold with a balanced perspective. While it offers protection and potential growth, it is also subject to its own cycles of volatility. No single asset class should monopolize your portfolio. Diversification remains your most powerful risk management tool. Turning from precious metals to tangible assets, let's examine real estate, an investment often referred to as concrete gold. Real estate's appeal during inflationary periods is rooted in its physicality and its historical tendency to appreciate over time. As the cost of goods and services rises, so too does the value of land and property. In the United States, this trend has persisted even through recent market upheavals. Throughout the first half of 2024, despite broader volatility in financial markets, many regions reported notable increases in residential property values. This resilience is not merely anecdotal. Real estate investment trusts, or REITs, offer a straightforward way for investors to tap into the property market without the need to buy, manage, or finance properties directly. The Vanguard Real Estate Index Fund ETF, VNQ, currently priced at $91.42, provides exposure to a diversified basket of real estate assets. VNQ's performance in 2025 exemplifies how real estate can serve as both a growth engine and a stabilizer in an inflationary environment. That said, real estate is not a one-size-fits-all solution. It requires significant upfront capital, and its illiquid nature means you can't always access your money quickly. Prospective investors should carefully assess location, market trends, and their own financial capacity before diving in. A well-chosen real estate asset, however, can be a powerful ally in the fight against inflation. Beyond gold and real estate, commodities represent another critical front in this battle. Commodities, such as oil, agricultural goods, and industrial metals, are the raw materials that power the global economy. Their prices are intrinsically linked to supply and demand dynamics, and during periods of inflation, they often experience robust price appreciation. Take oil, for example. The United States Oil Fund, USO, is currently trading at $71.71, reflecting both the persistent demand for energy and the upward pressure that inflation exerts on commodity prices. By investing in commodity ETFs like USO, you can gain exposure to this dynamic sector without the complexities of direct commodity ownership. Commodities are not limited to energy alone. Agricultural products, industrial metals, and even certain technology-related materials can see price spikes as inflation accelerates. These assets can serve as a counterbalance to traditional stocks and bonds, providing diversification and potential upside during inflationary periods. Let's not overlook the essential sectors, the companies that keep the world turning, no matter the economic climate. Stocks in essential sectors, such as consumer staples, energy, and healthcare, have demonstrated remarkable resilience. These are the companies that produce the goods and services people can't live without: food, beverages, household products, utilities, and medical care. Their ability to pass rising costs onto consumers helps them maintain profitability, even when inflation is surging. In 2024, while the broader S&P 500 faced challenges and volatility, the Consumer Staples Select Sector SPDR Fund, XLP, stood out for its defensive strength. Currently trading at $78.03, XLP includes a diverse array of leading companies in the consumer staples sector. Its robust performance is a testament to the enduring demand for essential goods, regardless of broader economic headwinds. This defensive quality makes essential sector stocks an attractive component of an inflation-resistant portfolio. By focusing on businesses with strong pricing power and consistent demand, you position yourself to ride out inflationary waves with greater confidence. Now that we've explored the key channels for inflation-proof investing, let's discuss how to bring it all together through strategic portfolio diversification. The golden rule in investing, especially during uncertain times, is simple: do not put all your eggs in one basket. Diversification is the foundation of any sound investment strategy. By spreading your assets across various classes, you reduce risk and increase your chances of weathering unforeseen shocks. Consider this illustrative allocation for an inflation-resistant portfolio as you step into 2025. 30% in real estate. For those with substantial capital and a long-term outlook, real estate can provide both appreciation and income potential. 20% in gold. This allocation gives you a solid hedge against currency devaluation and market instability. 30% in essential sector stocks. By investing in stalwarts of the consumer staples, energy, and healthcare industries, you benefit from consistent corporate growth, even in turbulent times. The remaining 20% can be allocated to other channels, such as commodities, short-term savings, or liquid assets, to ensure you maintain flexibility and can respond to changing market conditions. This diversified approach is not just about maximizing returns. It's about building resilience. Inflation impacts assets differently, and by owning a mix, you enhance your ability to absorb shocks and capitalize on opportunities as they arise. But even the best strategies can be undermined by common missteps. Let's take a closer look at some of the pitfalls that can derail your inflation-fighting investment plan. Mistake number 1: investing based on trends. The temptation to follow the crowd can be overwhelming, especially when headlines trumpet the latest hot asset. But markets are constantly evolving, and what worked yesterday may not work tomorrow. Instead of chasing trends, anchor your strategy in careful analysis and a deep understanding of your own goals and risk tolerance. Mistake number 2: failing to diversify. We've said it before, but it bears repeating. Concentrating your investments in a single sector or asset class magnifies your exposure to risk. Diversification is your most reliable defense. Don't neglect it. Mistake number 3: panic and sell-offs. Volatile markets can test even the most seasoned investors. It's natural to feel anxious when prices drop, but knee-jerk reactions rarely pay off. Instead, maintain a long-term perspective. Investing to fight inflation is a marathon, not a sprint. Stay calm, stay focused, and remember that market downturns often present opportunities for those who are prepared. As you map out your investment journey for 2025, it's essential to keep these guiding principles in mind. Inflation is not an unconquerable foe. With the right strategy, you can protect your wealth and even see it grow despite rising prices. Let's recap the strategies we've covered so far. First, gold remains a trusted and accessible hedge against inflation, with ETFs like GLD offering a convenient way to gain exposure. Its impressive performance in 2025 is a clear signal of its value in uncertain times. Second, real estate continues to deliver both appreciation and income potential, with REITs like VNQ providing diversified access and robust returns. Third, commodities, especially oil. Oil, represented by the USO ETF, offer a way to benefit from rising prices in the raw materials that fuel the global economy. Fourth, essential sector stocks, particularly those in the consumer staples arena, have proven resilient, with funds like XLP demonstrating defensive strength and steady growth. And finally, diversification is your most powerful tool. By thoughtfully allocating your assets, you can reduce risk and increase your chances of long-term success. As you consider your next steps, keep in mind that there is no universal formula. The right portfolio for you will depend on your individual risk tolerance, investment horizon, and financial objectives. Take the time to assess your needs, seek professional advice when necessary, and remain vigilant as conditions evolve. In closing, remember that inflation is not something to fear if you are prepared. The strategies we've discussed today are not just theoretical. They are grounded in real, current data and decades of market experience. By taking action now, you position yourself to not just survive, but thrive in the face of rising prices. If you found these insights helpful, consider sharing this knowledge with friends and family. The more informed we are, the better equipped we become to face economic challenges together. And if you want to stay ahead of the curve on all things investing, make sure to join us regularly. Stay curious, stay disciplined, and most importantly, happy investing. See you next time as we continue to navigate the ever-changing world of finance, always with an eye on protecting and growing your hard-earned wealth.